This is Module 6 of Accounting 3110, and this module is going to be actually a continuation of what we did in Module 5, where we were studying job order costing. We looked at direct material and direct labor, and then the overhead part of the cost is what we will cover today in this particular module. Let's go back to Module 5, though, and look at the for practice that was in your lecture notes for that module, and make sure that we do understand the basic elements of job order costing. For practice module 5, question number 1, we were simply going to determine whether it would be appropriate to use job order or process costing. And let's recall that it's going to depend on what kind of product that we make or what kind of business we are in. An oil refinery would use process costing, again, a homogeneous product. An architecture firm is going to keep track of its cost per job. A cereal manufacturer is where we have this situation of one unit looks like the next, and it would be appropriate to use process costing. When we have a cabinet maker who makes customized cabinets for individual customers, this would be an appropriate use of job order costing here. And when we're talking about a ship builder, this would also, each ship or each output would be unique, and job order would be appropriate. Number 2, costs related to each job are consolidated on a job cost card, and this is often called a job cost report. And going on to question 3, the cost of a job includes what cost components? It would be direct material, direct labor, and factory overhead. And finally, number 4, the cost of jobs started but not finished are represented in which inventory account? This would be work in process. Let's return now to the subject for today, which is factory overhead. This subject is about how we keep track of factory overhead costs, and most importantly, again, realizing that any cost that is included in factory overhead is what we would call an indirect cost. It cannot be traced to the cost object, in this case, the product. Let's talk about 2 different ways that the factory overhead can be approached. First of all, we have what we call actual costing systems, and an actual costing system simply means that the direct material, the direct labor, and the factory overhead that will flow through our product cost flow chart all represent costs that actually were incurred. They aren't anticipated cost, but they are actual cost of the period. So when we have an actual costing system, our overhead cost sometimes it's slow to be able to consolidate all those costs. So it can slow down our reporting a bit, just trying to account for all these various overhead costs. So one thing about an actual costing system, again, is that it would be kind of slow and maybe untimely in getting reports out to managers. Another problem with actual costing systems, particularly when we're talking about overhead cost, would be that in some months, overhead cost would be higher than in other months. Also, when we watch the way most companies produce or their level of production, it isn't constant either. There will be certain months where they produce more than they do in other months. When you combine the two to compute a cost per unit, where you have your overhead cost and then you have your level of production, what can happen is you can have overhead cost per unit that fluctuates greatly. And when that fluctuates greatly and we're giving our managers a different cost per unit every single month because of these fluctuations, that becomes very confusing and not very helpful to decision makers. So what we want to introduce you to is a system called a normal costing system. In a normal costing system, direct materials and direct labor remain actual. In other words, we keep track of the materials we actually use, and we keep track of the labor that we actually use to produce the product. However, there is a change in the overhead, the way we work with developing the overhead cost. So normal costing is going to use what we call applied overhead. And so we can begin to understand what we mean by applied overhead. I'd like to talk through the steps that a company goes through in order to use a normal costing system. Before the year would begin, managers would be asked to estimate total overhead for the upcoming year. Now, keep in mind that this is prior to the start of a year. We only do this rate development one time a year, and of course it would be done prior to the start of the year. We estimate total overhead, and we also are going to estimate the activity level of the cost driver. Now again, this is the process that a company would go through that uses a normal system. Actual direct materials, actual direct labor, but we're going to do what we will call apply overhead. So the first step is to estimate the total overhead for next year. Second thing we would do is we would determine the appropriate cost driver. What is the most appropriate cost driver? What is it that has a strong cause and effect relationship with overhead cost? Now, in this system, it may be units of output would be one example. Another company might use direct labor hours if it's a labor-intensive company. If it's highly mechanized, it may use machine hours. But what we're saying when we choose a cost driver, we're saying, for example, if we choose machine hours, the more machine hours we have, the more overhead cost we will also have. So we're looking for that cause and effect relationship. So step 2 is choosing the most appropriate cost driver. And again, this depends on the nature of your manufacturing operation. The third thing we have to do is then to estimate the activity level of the cost driver. In other words, if we choose machine hours, we're going to estimate how many machine hours we will use for the upcoming year. So 2 estimates are necessary. We estimate total overhead, and we also estimate the activity level of our chosen cost driver. When we, for example, might choose machine hours, what will come from this calculation is some kind of predetermined overhead rate. And it would be expressed as so many dollars per machine hour. So many dollars of overhead per machine hour. So again, it's very important to understand the timing. This rate is developed before the year begins. That's why we call it a predetermined overhead rate. In this case, it's going to be so many dollars per machine hour. Now, what is going to happen is when that year begins, for example, the month of January, then we would take this predetermined rate of so many dollars of overhead per machine hour, for example, and we would multiply it by the actual machine hours for the month of January. And this would give us what we will call applied overhead for January. So when the month of February comes, we will use this same predetermined overhead rate, but we will multiply the actual machine hours for the month of February, and that would give us the applied overhead for February. Now, what this does, it allows management accountants to go ahead and get the numbers out more quickly, because instead of waiting to determine all these actual overhead costs, we will simply use the rate, multiply by the actual activity level, and get our applied overhead and send it on through the flow chart. So I'd like to take a look at the flow chart right now for overhead. And remember, this is our third component of product cost. We are going to use this applied overhead to send overhead cost on to work in process. And you know also that material and labor will also be moving into work in process. But it is the applied amount of overhead, not the actual overhead, that will be sent on. And so this is your rate, predetermined rate, times the actual activity level of the cost driver. Now, what will happen later is, even after these overhead costs have been applied and sent on to the work in process account, later the actual amount of overhead will be determined. And it's very likely that the actual amount will not be the same as what we applied, because again, remember that our predetermined rate was based on 2 estimates. So when our estimates are off, the applied amount will not always equal, or actually will very seldom equal, the actual amount of overhead for that period. Let's talk about an example where we can use some real numbers and work through these steps of using a normal costing system. For this particular company, before the year began, management budgeted or estimated overhead for the next year to be $55,000. This is one of our estimates. Secondly, it decided that the most appropriate cost driver, which is another name for allocation base, would be machine hours. So this tells me that the operation here is machine intensive rather than labor intensive. The estimate had to be made for how many hours would the machine or the machines be running next year. So this is our second estimate. This would be 11,000 hours. So let's take that information and begin to work through this example. First, in Part A, it says, let's develop the predetermined overhead rate. Well, remember, we're going to take 2 estimates. We're going to take our estimate for factory overhead for the year, $55,000, and we're going to also use our estimate of machine hours that we will be planning to have in the upcoming year. and we get a rate of $5 per machine hour. This is called the predetermined overhead rate, and this is, again, calculated before the year begins. Now, the second question says, let's compute applied overhead. Applied means you're going to take the predetermined overhead rate and multiply it by how many machine hours actually were used in this particular month. So let's look at the information above, and it says actual machine hours were 1,000 for the month of January. So we will compute $5,000 of applied overhead for the month of January. The next step says let's use the T account and determine whether we have over or under applied our overhead using this particular rate. So this is our overhead account. Very important that you remember the applied goes on the right because that's what goes to work in process. Our actual overhead will be determined later and will always go on the left side of this account. So we'll put our applied here, knowing it's going to be sent on to work in process. Now, let's look at the actual. If you look at the information at the top of this problem, it says the actual overhead was $5,200. So later we determined that in this case, we under applied by $200. In other words, we only sent $5,000 of overhead through the flow chart, when in fact the actual amount of overhead was $5,200. So this is a case of underapplied. Now, what is going to happen to this underapplied overhead of $200? Well, if you follow the flow chart on through, we know that work in process moves to finished goods, moves to cost of goods sold. So our cost of goods sold figure is going to be too low because we only sent $5,000 of overhead. So we will, in this case, take the cost of goods sold from the flow chart, add the $200 of underapplied to get our actual cost of goods sold. And let me show you that again. I'll look at the flow chart all the way across. We know we have material and labor and overhead feeding into work in process, which feeds into finished goods, which feeds into cost of goods sold. We know that direct materials come in here in a normal system at actual. We know that direct labor represents actual labor, but in this case for overhead, we're going to use our predetermined overhead rate. And in this case, again, we sent through 5,000. We underapplied by $200. So whatever cost of goods sold ends up being, we will have to take that number and add anything that has been, any amount that has been underapplied in terms of the overhead. And that gives us actual cost of goods sold. Now, let's look at the final question here in part E, if we could return to that problem. We are asked to compute over or under applied if the actual for January had been $4,900. So in that case, the actual was less than what we sent through the system by $100. So in this case, we have over applied. And let's think about what that means. When we take our cost of goods sold, again, this moves to work in process to finished goods to cost of goods sold. If we have over applied here, our cost of goods sold is too high also. So we will subtract the $100 to get our actual cost of goods sold. So we can summarize here that when we over apply, we have to subtract the amount that we've over applied from cost of goods sold. When we under apply, as we did in the earlier example, we did not send enough. We must add that amount to cost of goods sold to get it to its actual amount. I'd like to take just a moment now and have you go back to what we did in the in Module 5, where we were learning about job order costing, and update that subject with what we now know about overhead. Let's say, for example, that you have a job and you're keeping track of the materials and the labor for that particular job. Well, what you will also have to do is keep up with the overhead that is being assigned or applied to that job. For example, we just saw where we used machine hours as the cost driver or the allocation base. And in this case, our overhead, predetermined overhead rate, I believe, was $5 per machine hour. If we have a job, then what that means is every time we use the machine for an hour working on that job, we will also have to assign $5 of overhead to the job. If we ended up working 3 machine hours, then we would have $15 of overhead being applied to the job. So it's very easy to do once we choose an appropriate cost driver and once we develop the rate. For example, maybe the overhead is going to be applied using direct labor hours. Then let's use an example. Maybe the overhead is $10 per direct labor hour. Then when we're working on a particular job, every time there's an hour of labor being used on that job, we not only have to put the labor cost in there, but we're going to also assign $10 of overhead for every one of those direct labor hours. So in conclusion today, when we talk about overhead, we are reminded again that it's a difficult area of cost because it is indirect. It is also an area that when we use an actual costing system, we don't get timely information like we would like, and we also probably have to put up with a lot of cost fluctuations. So to take care of those two problems, many companies use what we call this normal costing system, where we develop a predetermined overhead rate, and then as every period passes, we take the actual activity level of the cost driver and we multiply it by that rate to get what we call applied overhead. When we send too many dollars through the flow chart for overhead, this is called over-applied. When actual turns out to be greater than what we've sent through, this would be called under-applied. And ultimately, we're going to have to take our cost of goods sold and update it based on whether the overhead had been under or over applied. So again, the manufacturing overhead is one of our fastest growing areas of cost because machines are replacing direct labor. And even though it's the fastest growing area of cost, it still continues to be the most difficult and the most challenging area of cost to account for.